All right, welcome to The Explainer. I am so incredibly excited to have you here today. Look, if you're tuning in right now, I know you don't just want to scrape by and pass the IGCSE Accounting 0452 exam, you want to completely dominate it. Think of me as your academic coach for the next few minutes. Today, we're taking this sometimes tricky topic of interested parties and limitations and totally demystifying it right here on the whiteboard. So grab your notebooks, get comfortable, because we are going to build that absolutely crucial bridge between everyday data entry and actual high-level financial intelligence. Let's do this.
So here's our four-step blueprint for today. We've got 1, core accounting concepts, 2, technical execution, 3, ratios and evaluation, and finally, 4, examiner strategy.
Okay, let's jump right into section 1, core accounting concepts. This is literally the architectural requirement for an A-star.
You know, a lot of students kind of fall into the trap of thinking about accounting as just, well, a basic record-keeping exercise. But to grab that A-star, you have to shift your mindset. You really need to view it as the structural foundation of a business. And our starting point? The golden rule. Assets equal liabilities plus equity at all times during the fiscal period. Every single transaction has a dual effect, right? And keeping that scale perfectly balanced is step 1 to showing the examiner you really get it.
Now listen up, because this next part is a massive deal for the 2026 Cambridge syllabus. There is a strict shift in terminology. If you want top marks, using modern international terminology is totally non-negotiable. The days of casually writing bad debts or just capital, yeah, those are gone. You need to be using terms like irrecoverable debts and owner's equity, and honestly, you need 100% accuracy with them. The examiners are actively scanning your paper for this updated vocabulary.
Building on that, here's a quick, essential vocabulary checklist you need nailed down for paper 2. Accrued, prepaid, realization, and consistency. But here's the critical warning. Just memorizing the definitions won't cut it. When you see exam command words like apply or evaluate, you actually have to weave these concepts into really complex business scenarios. Like, you need to know exactly how a prepaid rent expense simultaneously pumps up your current assets while dropping your expenses for the year. It's all connected. So let's look at how these concepts actually protect a business in the real world. Take the prudence principle, for example. Let's picture a quick cause and effect scenario. Say a business just ignores some potential losses. Maybe a bunch of their inventory gets damaged in a flood, but they just leave it listed at its original historical cost. What happens? Well, they drastically overstate their profits. And let me tell you, examiners will catch an overstatement of profits linked to a prudence error immediately. You always have to anticipate those losses and only ever record realized profits. Now, you might be sitting there asking yourself, okay, why does this actually matter? Who really cares if my profit is overstated by a couple $100? Well, these guys care. The interested parties. You've got banks trying to decide if they should approve a massive loan. You've got owners demanding to know their true return on investment. Tax authorities figuring out legal obligations. They literally rely entirely on the integrity of your records to make huge annual decisions. If your base data entry is flawed, their high-level decisions just completely fall apart. All right, moving right along to section 2. Step-by-step technical execution. This is all about maximizing those method marks. Okay, so knowing the theory is fantastic, but this is where the rubber meets the road. We actually have to do the math to lock in the method marks. Let's walk through a quick worked example. Imagine a business buys inventory on credit. First, we start right at the source, the business document, like a purchase invoice. Now, the command word in your exam might say, prepare the ledger accounts. So you take that invoice data, you record it in the purchases journal as your prime entry, and boom, you immediately update your double entry T accounts. Even if you accidentally fumble a calculation later on, clearly showing this logical flow is exactly how you secure those crucial method marks.
And right smack in the middle of that workflow is the T account. Let's say you're closing off that payables ledger for the inventory we just bought. Honestly, mastering the structure is the gold standard. You have to perfectly calculate the difference between your debit and credit sides to find your carried down balance, your balance CD, and then bring it down to the opposite side as your balance BD for the new month. Knowing exactly where these sit at the end of a fiscal period is literally the difference between a trial balance that balances perfectly and one that leaves you totally stressing out in the exam hall.
Now, when you're working through these steps and you see the command word calculate, red flags should go up. There are some really common mathematical traps here. For instance, if that inventory purchase we talked about included both a trade discount and a prompt payment cash discount, students mess up the percentages all the time. Just remember the rule. You calculate the trade discount first, right there on the invoice, way before applying any cash discounts to the ledger.
Avoid those little traps, and your transition to the trial balance phase will be absolutely seamless.
Okay, let's dive into Section 3, Ratios and Evaluation. This is your AO3 high-level analysis.
This right here is what separates the passing grades from the A stars. Calculating a ratio? That's baseline. Interpreting it? That's high level. Let's make this interactive. Grab your notebook and a pen real quick. Here's an exam-style question for you. Let's say a business's current ratio suddenly drops from 2.5 to 1 all the way down to 1.1 to 1. My question is, why? What exactly is going wrong with their liquidity? I actually want you to pause right now and jot down 3 specific potential reasons for this. Go ahead, I'll wait.
All right, welcome back. Let's see what you came up with, and if it matches the financial intelligence the examiners are hunting for. When a current ratio plummets like that, you need highly specific analytical causes. Did you write down that maybe inventory was massively overpurchased, which just tied up all their liquid cash? Or maybe trade payables are being settled way too quickly? Or what about cash reserves just being totally wiped out because the business suddenly bought a massive piece of machinery? A huge capital expenditure? That is the exact level of diagnostic thinking you need to be showing.
Now, what happens when we need to evaluate and compare 2 different firms? This is inter-firm comparison, and it comes with some serious limitations. The biggest one, different accounting policies. Imagine firm A uses the straight line method for depreciation, but firm B uses the reducing balance method. Because their underlying policies are fundamentally different right from the start, comparing their final profit margins is literally like comparing apples to oranges. You absolutely must explicitly highlight this limitation in your written exam answers to lock down those top AO3 marks.
And hey, you've got to look beyond the surface numbers too. The raw data doesn't tell the whole story. You need to evaluate the actual quality of the profit by looking at non-financial factors. Things like, what's the staff morale like? Is their retail location still actually optimal? What about their overall market reputation? None of these factors are sitting there cleanly on a balance sheet, but they strongly dictate the business's long-term survival and their return on capital employed.
All right, bringing it home with Section 4, Examiner Tips and Strategy. Direct insights right from the recent reports.
So, I've been digging through the recent principal examiner reports, and I found this A-star secret trick question they absolutely love to use. They will try so hard to trick you into mixing up revenue items and capital items. Let's say a business is painting a brand new extension on their building. Is that just a simple day-to-day repair, or is it part of the actual new asset cost? If you mistakenly classify a capital expenditure as a revenue expense, you instantly understate your profit for the year and understate your non-current assets. The examiners explicitly warned that failing to separate these two is the #1 way students just hemorrhage marks. Don't fall for it.
Take a screenshot of this if you need to, because here is your definitive exam checklist. First, do write clearly in your ledger accounts. The 2025 reports flat out stated that poor handwriting literally causes students to lose method marks simply because the examiners cannot read the numbers. Next, do manage your time effectively and do pay attention to the weightage of the question. Look, if a question is worth 8 marks and the command word is evaluate, a quick 1-sentence answer is not going to cut it. You need points for, points against, and a solid conclusion. And finally, like we just said, don't ever mix up your revenue and capital items.
As we start to wrap things up today, I want to leave you with the core thesis of this whole explainer. Think about the modern real world. We have incredible AI-driven accounting software like Xero that automates so much of the math. But guess what? Those modern systems still completely rely on a human accountant to correctly classify the data going in. The ultimate goal here is financial transparency. Accounting is the art of transforming raw, boring data entry into actual actionable financial intelligence for all those interested parties.
So, I'm going to leave you with this final thought. You have the blueprint now. You know exactly where the pitfalls are. When that examiner sits down with their red pen and opens up your paper 2, will your records just show them mere data entry? Or will they see true high-level financial intelligence? The choice, and that A-star, is entirely in your hands. Thank you so much for joining me today, and absolute best of luck with your revision. You've got this.